All right, Dan. Dan's actually controlling the slides here from his computer, so you can go to the agenda here. And just want to welcome everybody. Thank you so much for coming today. And we do have three main topics today. The first one we're going to talk about is the accounting and income tax considerations for your PPP loans. The second, and I'm going to go over that. And then the second one is some payroll tax credit information from the CARES Act and some things about W-2 additions, and Jamie will be presenting that. And the third one is tax legislation, the Wisconsin entity level election for pass-through entities, and then some thoughts on the election and Joe Biden's potential proposals. Dan Bergs will be going over some of that. So I know it's been a long haul with the PPP loan stuff, and we've had a lot of different webinars on that. And but today we are just going to be talking. A lot of people have been asking, how do I account for the PPP loans on my books? How does it affect our audited financial statements? And more importantly, how does it affect our income tax returns? So I'll be starting with that information. And the first thing I want to do here is I do have a few, I guess they call them disclaimers, and it's not, the disclaimers are not to protect us. It's more to help you as the audience understand what we are talking about today and what we're not talking about today, just to be clear. So the first bullet point here, when we talk about the PPP information today in this webinar, is designed to assist traditional for-profit businesses. If you represent a nonprofit organization, just be aware that the nonprofit accounting rules will likely differ from these slightly. So this webinar today is geared towards for-profit businesses. And again, if you're a nonprofit organization, we do have a lot of resources for nonprofits as well. Just feel free to reach out to your Wagner representative for that. The second bullet point here, the PPP information that I will be talking about is limited to the GAAP accounting and income tax reporting rules. We just don't have time today to get into all the different nuances of the PPP program as far as, what are qualified expenses, how do you apply for forgiveness? We have covered a lot of that information in previous webinars, and we do have a lot of information on our website. There's a link here on this slide on our Wagner CPA's website. We do have a couple tabs called, under our resources tab, called COVID-19. And there's a lot of information there on the PPP program, the ins and outs of it. There are those previously recorded webinars as well. So feel free to look at that. But just to be clear, today because of time constraints, we're only talking about the GAAP accounting and income tax impact of the PPP loan itself and the forgiveness. And then the third one really is kind of a disclaimer. It's, the rules, anything related to the PPP program, those rules have been changing as we go on the fly. If you've been paying attention the last, 8 months or so, things have been changing continuously. And what we're talking about today is everything we know as of today's dates. And we actually have had some pretty good clarity that we've received in the last couple of weeks even, especially related to the income tax rules. So I think we're in a pretty good place now. I can't guarantee that everybody's going to like the answers that we're getting, but we do have some clarity and some answers. So what I'll do is I'll keep this into two different buckets. The first bucket is going to be GAAP financial statements. And when I say GAAP, that means generally accepted accounting principles. So if you have an audited financial statement, a reviewed financial statement, or compilation financial statement, those typically all use GAAP accounting rules. And so we're going to start with that. And then later I will talk about the income tax rules, because the GAAP financial statement rules don't always mirror the income tax rules, as you know. And probably the easiest example of that would be, I think most people understand that there's different depreciation rules, for example, for financial statements versus income tax returns. So likewise with the PPP loan, there could be some different financial statement rules related or compared to the income tax rules. So I'm going to start with the GAAP accounting rules for PPP loans. And there are two possibilities of what you can do for GAAP accounting. And notice I used the word possibilities. I did not use the word options, because depending on your circumstances, you can't necessarily just pick and choose one of these two possibilities. So of the two possibilities, the first one I will talk about is called, I would refer to it as the debt model. And it's fairly intuitive, fairly easy to understand. And it's probably what you did when you first got the PPP loan. You recorded the cash on your balance sheet, and then you probably recorded a loan payable, called it a PPP loan, whatever, on your balance sheet. That's probably what most people did to start when you first got the money. So under this debt model, you would record it as a loan when you get it, and then you would accrue the interest at the stated interest rate of the loan. I believe the PPP loans are 1%. You would not have to worry about whether that's a market rate of interest or not. You simply would accrue interest as you go at the stated interest rate. And then you would continue to record this loan and the accrued interest as liabilities on your balance sheet until either the loan is forgiven or you pay off the loan. So obviously, if you took out a PPP loan and then you need to pay it back, that's just like any other loan. So that's very easy from an accounting standpoint. It wouldn't be any different than any other loan. A little bit of a difficulty becomes is when you record this as a loan, and then what happens if it's forgiven. And so if it is forgiven, either partly or in whole, what you do at that point in time is you reduce the liability on your balance sheet by the amount of the forgiveness. And then you would record something called a gain on extinguishment of debt. And that hits your income statement, kind of like an other income or miscellaneous income on your income statement. And the important thing here with this debt model is the timing of it. So if you use this debt model and you record this PPP loan as a loan, you have to keep that as a loan on your balance sheet until you actually receive, the actual notice from the SBA that it has been forgiven. It's kind of a bright line thing. So if you took out a PPP loan in 2020 and you're going to use the debt model, and if you're not going to find out, you don't know that it's been forgiven until 2021, then you're going to have to keep this on the balance sheet as a loan payable at December 31 if you're a calendar year financial statement, because the gain on extinguishment is not triggered until you know for sure that it's been legally forgiven and you've been legally released from this obligation. The last bullet point here says that the debt model can be used by any business. So in some regards, this debt model really is an option for anybody. And it kind of is I would call it a more conservative approach. I think a lot of people would think that until we know that it's forgiven, it probably is more conservative to keep it on the balance sheet as a loan payable. So in some regards, it is a more conservative approach. And I did say here also beware that if you do show this as a loan on the debt model, that it will impact the comparability of your financial statements quite a bit. I mean, we have some clients that don't have a lot of debt on their balance sheet, and all of a sudden they might have $1 million PPP loan. So that can really affect things such as loan covenants. And so you might need to be in touch with your banker on things like that. So that's the debt model. That's one possibility. And again, anybody can use this debt model if they want. So now we'll go to the next possibility, which we call the in-substance government grant model. And for simplicity, I'm just going to call this the grant model. So we'll have the debt model and the grant model. Under this grant model, an entity expects to meet the PPP's eligibility criteria and concludes that the loan represents in substance a government grant that is expected to be forgiven. So an easier way to say that is basically if you took out the PPP loan and if you know for sure you were eligible and you documented all the expenses you used it for during the covered period, and you're absolutely sure you really don't have any doubt that it's going to be forgiven at some point, then you can use this grant model. So what you do with the grant model is you initially record the cash on the balance sheet and then the PPP as a liability, not necessarily a loan payable, but as what we would call deferred income. It's kind of the same thing as a loan. It hits the liability section of your balance sheet either way. But then you subsequently reduce the liability and you recognize the earnings impact systematically over the periods in which you recognize as expenses the related costs that the grant is intended to compensate. So if you had incurred half of the expenses, then you would reduce half of the liability at any given reporting period, if it was a month end or whatever. The earnings impact, which means when does it hit the income statement? It may be presented on the income statement as either other income or as a reduction of the related expenses. My strong opinion and strong recommendation is that you should show that as other income on your income statement. If you picture your income statement, normally your income statement, it starts with sales, and then you subtract cost of goods sold to arrive at your gross profit, and then you subtract general administrative expenses, and then you come down to what's called your operating profit. Then after that, there's usually another section called other income or expenses, and that's where you put the unusual things. And to me, this PPP is obviously an unusual item, so I would strongly recommend putting it there instead of reducing expenses. Because if you think about it, if you reduce expenses, if you reduce your cost of goods sold or you reduce G&A expenses as offsetting, that's really going to mess with your comparability of your financial statements, and your ratios, your gross profit percentage could look all out of whack for 2020 compared to other years. So that's why I recommend putting this down in that other income section of the income statement. Let's see. This government grant model can only be used if it is probable that the loan forgiveness criteria will be met. So in order to use this grant model, you really need to be confident that you've really met all the requirements of the program, that your expenses that you're applying for forgiveness are legitimate according to what's allowed, and that you're very confident that it will be forgiven. And then the last bullet point here is, well, then what happens if in a subsequent year some of the loan is not forgiven? Then at that point, you're going to have to treat it as a change in estimate, which basically means it'll affect your future income statement. You don't have to go back and reissue your prior financial statements. So those are the rules. There's the debt model and the grant model. And so you say, okay, well, those are the rules. Well, what is it in English, and what are most companies going to do? My opinion is that for most companies that have a December calendar fiscal year end, I don't think there's going to be a lot of mystery involved with this, because I suspect that the majority of my clients will already know whether a lot of them probably already know whether it's forgiven or not, or they're going to be pretty confident one way or the other. And I don't foresee a lot of my clients using the debt model just because of that, because I think by the time financial statements are ready to be issued, especially for a calendar year company, I think there will be a pretty good feeling of whether those expenses will be forgiven or not. So my thought is that probably the majority of my clients will probably gravitate towards the grant method. But again, if there is uncertainty about whether it'll be forgiven, then you need to use the debt method. So again, anybody can use the debt method, but only certain people can use the grant method if you're confident that it'll be forgiven. So hopefully that makes sense. A couple other little minor items about financial statements will be in the disclosures this year. You'll see that if there are PPP loans, you need to disclose that accounting policy that you're using for the PPP loans, basically the debt model or the grant model. You will need to disclose which policy you're using and how that impacts your financial statements. And then there probably will also be a disclosure in your financial statements this year that of this overhanging contingency that the SBA has up to 6 years to audit these loans. So even if they say they forgive your loan initially, they still could come back a couple years later and audit you. And there's this potential contingency hanging out there that if it's audited and if for some reason they decide that really you weren't eligible or that you should pay it back, that's something that probably should be disclosed in financial statements simply because of the size of this loan. I mean, there's always contingencies out there in any company. It could be related to, sales tax audits or whatever. There's always kind of things out there, but just due to the size of this, and we have clients that have, well over $1 million PPP loans. And that is kind of a big thing that's hanging out there that this whole, because there hasn't been a lot of guidance on how the SBA is going to audit these things. So I think you'll probably see some disclosures in our financial statements this year related to that. So I think that concludes the financial statement gap treatment for the PPP loans. And so now I'm going to move to the tax treatment. And this has obviously been a very hot topic. And we actually received clarity from the IRS just within the last 2 weeks or so on how this is going to work. We've really been waiting a long time for this. So the first bullet point here says, if the PPP loan is truly a loan that will need to be paid back, then it's easy. Then it's just a loan. Then it doesn't affect your income taxes at all, other than the interest expense that you incur on it is deductible. So if it's a loan, that's easy. It's just like any other loan. Now, the second bullet point is where it gets really tricky and where we've really been struggling the last 6 months trying to figure this out. So here we go. If the PPP loan is forgiven or is expected to be forgiven, the forgiveness of the loan itself is not taxable income. That was specifically written in the CARES Act, as the intent of Congress was that when this PPP loan is forgiven, it will not be taxable income to you. However, about a month after that, the IRS came out with a notice and said, fine, okay, then yeah, that's not, the forgiveness itself is not taxable income. However, the IRS says we are not going to allow you to deduct the expenses that you use those PPP funds for. So in essence, kind of through a backdoor way, the IRS says, yeah, it kind of is taxable income to us. So we have known this for quite a while. I mean, back to, I think it was in April or May that the IRS came out with this. We knew that the IRS position was that these expenses are not deductible. The big question for the last 6 months or so was what's the timing of this? I mean, what if you don't have this forgiven until 2021, but you incurred these expenses in 2020? So that's been kind of the ongoing question. So Dan, if you want to flip to the next slide. So what we found out just about 2 weeks ago is this revenue ruling 2020-27, which says, and I'm going to read this. I normally don't like to read stuff on a presentation, but I'm going to read this slowly because I think it'll make sense. A taxpayer that received a covered loan guaranteed under the PPP and paid or incurred certain otherwise deductible expenses listed in Section 1106B of the CARES Act may not deduct those expenses in the taxable year in which the expenses were paid or incurred, if at the end of such taxable year, the taxpayer reasonably expects to receive forgiveness of the covered loan, even if the taxpayer has not submitted an application for forgiveness of the covered loan by the end of such taxable year. So what they're saying is that these expenses were incurred in 2020. And if you reasonably expect that this will be forgiven, then you may not deduct these expenses in your 2020 tax year, regardless of whether you know whether it's actually been forgiven or not, or regardless of whether you've even applied for forgiveness yet. So I think, so what we're going to have is we're going to have a lot of 2020 clients with tax years that we are not going to be able to deduct these expenses, because I think the vast majority of our clients expect forgiveness for these PPP loans. So that's where we're at right now. And I think that's obviously going to create a tax impact for a lot of clients, because again, if you have had $1 million PPP loan, and now all of a sudden you can't deduct $1 million of expenses, your taxable income could be really high in 2020. So we're in the process of, obviously reaching out to all our clients here for year-end tax planning. So we definitely want to be doing some projections this year for that. And so I think you can go to the next slide, Dan. Let's see. Oh, just one thing on this too. So then what happens then if we don't deduct these expenses this year? And then what happens next year in 2021 if for some reason the SBA does not allow forgiveness? Well, the IRS made this pretty easy. Again, this came on the last 2 weeks or so. They're giving options basically, and you will be able to get the deduction. So if you haven't filed your 2020 return yet, then you can obviously deduct them on there, or you can file an amended 2020 return, or you can even just take the deduction on your next year's return. The IRS is actually giving some options here, some easy options to, if for some reason something changes in the future year that it was not forgiven, you can do that. So let's see. One other thing we have had some clients who are sole proprietors. They file Schedule C businesses, and if they don't have any employees, they may have gotten a small PPP loan just to base like their replacement income for themselves. And everything we know as of right now is there really aren't, in that case, there aren't any expenses to add back. So it's a little bit of a different situation than a company that used PPP for other employees. That company, has the non-deductible piece, but a sole proprietor even a partnership partner who took PPP income as replacement income. At this point, we don't think there really are any expenses that we don't think there's going to be any add back of this, which again is a disconnect between those types of businesses and other businesses. But the intent of the law was that the expenses that you're deducting are non-deductible. Well, a sole proprietor doesn't deduct their own compensation, so then therefore there really isn't anything to add back. The last bullet point here before I wrap up is there has been a lot of talk in Congress. Let me back up. When the IRS came out and said that these expenses were non-deductible, there was a big uproar politically about this, and there were some proposals floated in Congress to specifically change that, to specifically say that you would be able to deduct these expenses for PPP loans. As of this point, those proposals have gone nowhere, and I don't know whether they haven't gone anywhere because Congress just doesn't really want to deal with it anymore, or maybe they just weren't dealing with it because there was the election and there was the Supreme Court thing that was going on. So there's a possibility that Congress could still enact legislation that would allow the deductions for these expenses. And I think a lot of people are hoping for that, obviously. As of now, they have not done that. So we have to play by the rules that we have as of today, which I mentioned before. So just, we'll obviously be watching for this, if Congress decides to change anything. But as of today, we do have clarity on, for both GAAP and tax rules. Again, you may not like the fact that you can't deduct these expenses, but that's where we're at as of today. So I believe that is what I had to say. And we will be hanging around after this for questions. I do want to keep moving here to turn this over to Jamie, just in the interest of time. But again, we're going to stay afterwards. We're happy to answer any and all questions afterwards. So thank you for your time, and I'll turn it over to Jamie.
Hi, everybody. I remembered to unmute my line, so that's a plus. We'll get started here. There's been so much going on, as John referred to, with the PPP, with the payroll tax credits and things that are affecting our payrolls. There's quite a bit going on there as well. So the first thing that we have up here is the employee retention credit. So a company is going to be eligible for this if their operations were affected by a government suspension order. So when we had to do the shutdowns for bars and restaurants, it's a full or partial suspension based on your order. That could be statewide, that could be local government, federal government. So if you have some kind of order, you're potentially eligible. Or if you had a decline in your gross receipts. So that's going to be by quarter, and you're going to compare that to your previous quarter of the prior year. So for 2020, you're going to look at, let's say, second quarter of 2019 compared to second quarter of 2020 to determine if you've seen a decline and potentially could be eligible for the credit to retain your employees. So we go to the next slide there, Dan. So this slide just gives a little bit more information on what the credit could be for. It's 50% of the first $10,000 of wages paid, and you get to include your health insurance costs. As the slide says there, it's from the March 12th, 2020 through the end of this year, those wages that could be eligible. The biggest thing to remember on all of the payroll credits and the PPP funding as well is they're trying to avoid any double or triple dipping. So you need to be aware, if you qualify for the retention credit, those wages can't then qualify for PPP forgiveness or can't qualify for the Families First Coronavirus Act for any sick leave pay. So you just have to be very careful when you're recording this in your files on which wages are paid for which purpose and how you're taking credits. And the biggest thing that I've seen with my clients is that you're not eligible for this credit if you've received a PPP loan. So a lot of people receive the PPP loan, potentially aren't going to see this credit as often as some of the other options. And then down below, it begins with second quarter, and you're going to reconcile this on your 941 that you file quarterly. There's a worksheet to kind of help with the calculation. And that's where you're going to take the credit. And if you have extra, it's against your Social Security. And if there's an extra portion, that will be refundable on your 941. So all of the reconciliation on this payroll credit is done on the 941. The next up, this is kind of the one that I've seen used most frequently, is the Families First Coronavirus Response Act, the sick leave pay. You have to really determine what the reason is that you're paying your employees for. So there's different categories or buckets that you could fall into. If you're an employee that has to quarantine because you actually have COVID, or you are required to quarantine because you were a close contact, that falls into the 2 weeks paid up to the full regular rate of the employee. As you see there on the slide, up to $511 per day. It's an 80 hours, excuse me, amount of hours that can be paid to an employee. A lot of the questions that I see regarding this act, for smaller employees, if you don't already have a sick leave policy, do I have to pay my employees for this? Under this act, yes, you do have to pay. There are some exceptions that we'll talk about here as we get through the slides. But for the most part, if you're under 500 employees, yes, you are required, whether you had a previous sick leave policy or plan going into this COVID times. As you see there, the other reason you could be paid is if you have childcare issues, school closings, or you're caring for somebody that has to quarantine. That would entitle employees to 2/3 of their regular pay, up to the $200 per day. Again, same 2-week period. There is an additional 10 weeks of family and medical leave, up to $200 a day. Again, at that 2/3 rate, if you're caring for a child who cannot attend school, or childcare, daycare closures because of COVID related. And then the top dollar here that you want to be aware of, it's $12,000 over that 12-week period of what you can, the max you can pay that you would be eligible for credits. Excuse me. So again, going back to, let's see, this is thank you for advancing that slide. The covered employees, 500 or fewer employees, small businesses, if you're under 50, you may be exempt from paying this sick leave, but it's really only exempt from the school closures or the daycare closures. So you're still required if somebody is quarantining because they have the virus itself. And it's really only if it jeopardizes your business. So some of the conversations that I've had with clients is it's really a no-brainer to utilize the Family First Coronavirus Response Act and pay people the sick leave, because you're getting all of the credits back. You get 100% of their wages up to that dollar amount. You get a portion of the health insurance costs, of the Medicare that you're paying, and it's not subject to the employer's Social Security. So really, the only thing that the employer is out is the time that those employees would be working for them. So the production time or trying to fill their hours for a service-based business. It is limited though. I've had other clients ask, it's up to the 80 hours. So in a lot of circumstances, what we're seeing now is maybe somebody had to quarantine because they were a close contact. So they did their stint there. Maybe they used up the full 80 hours. Maybe they didn't have to use up the full 80. And now they're a close contact again, or maybe now they have the virus itself. So it's a one-time, it's up to that 80 hours. So this particular employer was worried about paying for all the reoccurrences that somebody might be a close contact. And that's not the case. The employer could choose to do that, but the credits are really based on up to that 80 hours, up to the dollar thresholds, et cetera. So you want to be mindful of that. The other thing that employers should really be doing is having a separate pay code for these hours that they're paying the sick leave, so that it's easily tracked, whether you're doing your own payroll or you're using a third party provider to process payroll. They need to be able to pull those hours out and really delineate those for the 941 for that reconciliation, as well as, again, back to that PPP, if you've got funding there, that those wages aren't double counted for the credit and for the forgiveness. Let's see here. anything else to add? I think that's really it on this slide. This next slide kind of goes over the credit. I've touched on a lot of this already. The fact that it's reported and reconciled on your 941 to reduce your 941 taxes. It's the 100% of the qualified wages plus the health insurance, the Medicare, and it's not subject to FICA. So we've already kind of covered this. It started with second quarter. So as you can see there, it's back from April through the end of this year that people would be required for credits. At this time, I have not seen any extension of that, the time frame of those wages that would be counted. So that is, next slide, please. We threw this slide in. I really don't want to spend a lot of time on it because as it says at the top, this is not a recommended thing for employers or employees really to take advantage of. These acts did allow the deferral of the FICA taxes for employers where you could take your payments that would apply there from the end of March through the end of this year and basically pay those 50% at the end of 2021 and 50% at the end of 2022. Again, we really don't recommend this. We don't know what the future holds. And I feel like it's a really slippery slope as you defer these payments to then have to come up with basically a balloon payment in a couple of years when we don't really know how businesses are going to perform through the next couple of years here as we still are working through this virus and it's still very impactful on the day-to-day. So again, we don't recommend doing this. If you did do it, there's no interest or penalties as long as you're able to pay those amounts by their due dates. The other thing that the president signed effective September 1 through the end of the year, employees could choose not to have Social Security tax taken out of their paychecks. This, again, another slippery slope because it's not a forgiven, it was a deferral. So at the beginning of 2021, people would be hit very hard with basically doubling up to catch up over those first 4 months of 2021. I think it was January through April to basically pay back that deferral. So again, not a recommendation. It's just too hard for people to know what the future is going to hold, and it's better to just pay that money as you can now. So that's really all on that slide. That kind of takes us through the payroll credits that I wanted to touch on. The next slide here is just the year-end W-2 additions. We kind of thought that fit in well as we were talking about payroll items. We're approaching the last year of 2020 here. So it's always a good reminder to note that, if we have a personal use of auto, so an owner or employee is using a company vehicle and they're driving it full time, whether it's work related or personal related, just wanted to that's a more common one to draw attention to, that there's some calculations that have to be done, and that personal portion really is a taxable fringe benefit that needs to be added to W-2s. So again, we recommend that if you have something like that, reaching out to your tax advisor and figuring out kind of what calculations or what method makes sense for you to get that added to W-2s. The other most common one that we see added to W-2s is S-Corp health insurance. So for the S-Corps out there, anybody that's a 2% owner or more, there is a requirement to add those health insurance costs to your W-2. Again, this is really a benefit for the S-Corp because they get the deduction through wages on the business, and the employees pick it up on their W-2, or the owners pick it up on their W-2. The business then essentially pays for the health insurance, so it's not out of pocket for the owner. And then on the 1040, it's picked up as wages, but there's also a front page deduction for SE health or self-employed health. So it's really a wash on the 1040 there. Again, that's going to affect boxes 1, 14, and 16. So box 1 and 16 are your federal taxable for box 1 and your state taxable wages, box 16. And then the 14 is really just a disclaimer showing what's been modified to your W-2. And then we also have a reference there for the publication. You can go and read through that for some other W-2 or taxable fringe benefits that should be added. Let's see. The next topic here is the 1099 NEC. Some of you may have already heard about this. You might be getting, if you're using QuickBooks, you might be getting some notices from Intuit about making sure your QuickBooks is up to date to handle this new form filing. It's basically the same. We used to file non-employee compensation on a 1099 miscellaneous in box 7, and there's been changes made to create a new 1099 NEC, non-employee compensation. So that's where the old box 7 is going to now be reported in box 1 of this 1099 NEC. Box or 1099 miscellaneous will still be used for other income, rents, those kind of things. So if you had to issue 1099s for those in the past, they'll still stay on that 1099 miscellaneous. It's going to be all of your non-employee comp that's going to go on this NEC. And the other big thing here to remember is that it's due to the IRS and the recipient by the end of January. So this year we're looking at 1/31 of 2021. In the past, if you electronically filed your 1099s, the IRS might have gotten a copy of those 1099s the end of February, beginning of March. So that's a big change for the 1099 NEC. And it's really a push to match those with people that are filing their 1040s super early to help the IRS match and make sure that all the income is being picked up. And then the big thing there we like to always add about the late filing fees, they are $50 per 1099. So if you had to issue 10 1099s and you didn't issue them timely, you're going to get a $500 penalty right off the bat. So just keep that in mind as you're reviewing your files for year end here, that you're requesting W-9s and getting that all complete ahead of time so that you have the information to file these timely. And that's all I had. So Dan, if you want to take it away.
Yes, yeah. So I'm going to talk a little bit about tax legislation, the Wisconsin entity election, and then some potential future legislation. I will also give a disclaimer that if you hear loud noises and screams, I promise it's just my little kids upstairs, so no one's being harmed. Some depreciation changes that came through this spring. One big one was a modification for what's called qualified improvement property. And that's for improvements made to interior portion of a commercial real property. So if you have an apartment building with residential tenants, that doesn't qualify for this. This is really focused on business property. And the improvements must be placed into service after the building's original date. And they don't count, if you're expanding a building or if you're putting in elevators or escalators or changes made to the internal really structural framework. And this change is effective back to the beginning of 2018. This is a pretty beneficial change for businesses. So I want to touch a little bit on, why is this a beneficial change? Improvements that are qualified improvement property get great depreciation benefits. Normally, a commercial building has a 39-year life. You get a 15-year life under this qualified improvement property. And it also allows for bonus depreciation in Section 179. I'll touch on these a little bit more in the next slide, but these are methods to generally accelerate depreciation into 1 year instead of spreading it out over a number of years, over a 15-year period in this case. And there's some considerations to be made here. If you have something that was placed in service that qualified for this in 2018, you've got a couple options. You can go back and amend the tax return to adjust the life of this property, or you could file a change in accounting method form and apply the adjustment in 2020. I'll give an example here in the next slide of kind of where this might play in and how it might factor. So let's say you made a $195,000 improvement to your business building while doing a remodel in 2018. It meets all the qualifications for qualified improvement property. Under the former rules, the old rules, this would be depreciated over 39 years at $5,000 a year. So you're getting a really small piece of depreciation every year for something that you made a pretty good size investment in. Under these new rules, you can take accelerated depreciation and you could, take bonus depreciation and fully deduct that $195,000 improvement. So there are some pretty significant tax benefits to this. And there's some things you kind of have to think about. And some of those things are, if you fall into this qualified improvement property, consider, what type of entity are you? If you're a partnership, or if you're an S corporation and you've got a number of shareholders or a number of partners, if you go back and amend your return in 2018, you kind of have to consider, if you amend the business return, you also have to amend all of the shareholders or partners in that partnership. So weigh some of the factors, as well as, what was your income in 2018 versus or 2019, if this is something that happened in 2019 for your business and you didn't take advantage of this. And what's your income looking like in 2020? So if you're in a higher tax rate in the year that it occurred versus in 2020, or if you're in a higher tax rate in 2020 versus the year that this originally occurred, you want to talk to your tax advisor, because there's some planning here that you look into to try to figure out what are the best tax benefits. And in some cases, it might be better to do a change in accounting method form and apply this change in 2020, call it for the convenience factor of not having to go back and amend prior year returns, and maybe open up those years as well for a few more years, and what's called the statute of limitations, where the IRS could look at those years a little bit further on, as opposed to making the change in 2020. So that's one thing you want to talk about with your tax advisor, because these can provide some pretty significant benefits. So I will talk about depreciation limits for 2020 as well. As far as accelerating depreciation, there's really two ways to do it. The first one is what's called Section 179. And the maximums for Section 179 in 2020 is $1,040,000. If your business spends more than $2.59 million on fixed asset purchases, the amount you're eligible to deduct starts decreasing, dollar for dollar once you're over that threshold. So this is certainly something to consider. A lot of businesses don't have over $2.5 million in fixed asset purchases. So Section 179 is a common method used to reduce their income. A couple of nuances with Section 179 is you cannot reduce business income below zero. So if you're in a case where you've got $200,000 of profit in your business, you bought $400,000 of equipment during the year, you cannot take Section 179 to reduce your income to negative $200,000. You can't go into a loss with Section 179. You can just bring it down to zero. Another benefit of Section 179 is Wisconsin has the same limits as the feds. Section 179. Each state is different when it comes to depreciation modifications. Some states follow the federal for everything. Some follow for just Section 179. Other states kind of have their own methods of depreciation. So you certainly want to reach out to your tax advisor, because states are not always following the federal depreciation rules. With respect to bonus depreciation, one benefit is there is no annual limit. So bonus depreciation fully reduces the cost of the assets, and this is generally assets under 20 years. So 5, 7, and 15-year assets are the most common where you're going to apply bonus depreciation. And another benefit is bonus depreciation can reduce business income below zero. So in that same situation, before applying depreciation, if you have a company that's got $200,000 of profit, they bought $400,000 of equipment during the year, they could bring that profit down to a $200,000 loss. It's not always recommended to do that for a variety of reasons. There's partner shareholder basis issues that can factor in there to make sure that individuals can actually take those losses. It's a little bit different with the C corporation. And there's other things you want to factor in as well. If you're going to take a loss for a company by using bonus depreciation, you also want to make sure that you're kind of weighing the factors of, if you financed that equipment that you purchased, you're paying off that debt in future years. You have to pay off that debt with business profits. So sometimes it makes sense to kind of match your depreciation deduction with what you financed, so that as you're paying off equipment, you're getting the depreciation for that equipment at the same time. One disadvantage for bonus depreciation is you must apply to all the assets in that asset class. So for all of your assets during the year that are 5-year property, it's all or nothing for bonus depreciation. You can't pick and choose the assets like you can with Section 179. The same thing with 7-year assets or 15-year assets. You can do it for all 5-year assets, not do it for 7-year or 15-year, or do it for all 7-year assets, not for 5 or 15-year assets. But it's not as flexible as you are with Section 179. In Wisconsin, again, that's kind of the state that we're in, but different states have different rules. Wisconsin does not allow a bonus depreciation. So it does create a federal and Wisconsin difference between the two. Another change are net operating loss changes. This applies for C corporations, again, paying tax as an entity, as well as individuals. So the changes here are any losses occurring in 2018, 19, or 2020 can be carried back to get refunds from tax paid in prior years. So where this might benefit companies is if you're a C corporation and you pay tax in a higher rate 5 years ago than the current rates. The rates used to be 35% for C corporations, and now they're at 21%. So if you incur a loss in 2018, 19, or 20, you can carry that back and you can get refunded from those prior tax years. As we'll talk about a little bit upcoming here, there's also some anticipations that the tax rates might go up here for C corporations. So electing to not carry back and carry those forward is also a viable option. I didn't put it on the slide here, but another thing I do want to talk about a little bit is as part of the tax reform for 2018 and 19, there were limits for businesses that had passed through losses. So those are S corporations and partnerships. And those limits were $250,000 for individuals. If you filed jointly, it was $500,000 of losses that you could take. And there was also legislation that kind of went away with that as well. So if you had losses exceeding those amounts from combined partnership and S corporation interests, reach out to your tax advisor on that, because you may be able to take those losses on those returns depending on your situations, and it might provide some pretty significant tax benefits for you. Interest expense modifications for larger companies. I'm not going to spend a lot of time on this. This only applies to businesses in excess of 26 million of average gross revenue over the past 3 years. And the change in the business interest expense deductibility was from 30 to 50%. Again, this only applies to larger and highly leveraged companies with a lot of debt. If you're in these situations where you're above that 26 million threshold and you've got some debt on your company's books and you may be highly leveraged, certainly reach out to us or reach out to your advisor and kind of look at what impact this is going to have on your company. Because for larger companies, this does have a pretty significant impact. I'm going to spend some time here talking about the Wisconsin entity tax election. So this is applicable for S corporations and partnerships. If you're a C corporation, this does not apply to you. Again, just S corporations and partnerships. And essentially what this is companies are going to pay the Wisconsin income tax at the entity level. So an S corp or a partnership is essentially going to pay a corporate franchise tax to the state of Wisconsin. And then their shareholders and partners do not pay that income tax individually. So I'm going to walk through some pros and cons here, then a couple other questions on where it might make sense to kind of look into this for your businesses. One pro is that the entity level tax is deducted on the company's federal tax return, therefore reducing the company's federal income. Now, a couple of years ago, this goes back to some individual tax changes that occurred for 2018. And individuals on their itemized deductions can only deduct up to $10,000 of state and local tax paid. So that includes your property taxes, includes any state income tax that you pay. So a lot of higher income individuals are no longer really getting a lot of benefit from paying higher state income tax. And this entity tax election allows businesses to pay tax at the entity level and get a valid deduction on their federal return. So it reduces the company's federal income and it reduces the tax that the individual is paying on their federal income tax. So the individual do not pay tax on this income. It's paid at the entity level. The individual doesn't pay anything on it. It essentially is just a subtraction from their federal income. For whatever federal income is reported, you don't pay any tax on this income individually. Another benefit is this is an annual election, so it's not something that's mandatory to do if you decide to start it. You can do it 1 year, not do it the next year. It just depends on what your expectations are for the company income. Some of the cons here is the entity level rate is higher than the top individual rate. So you are paying more tax to Wisconsin by doing this, which is one of the reasons that they kind of brought this into law a couple of years ago. Another con is the entity level tax does not allow for charitable contributions. There's certainly some planning in this area. If you have tithing that you do as a business, or if you have charities, nonprofits you like to support for your businesses, you can kind of get around this if you do sponsorships for events and you get advertising for those events versus just writing a check for a charitable contribution. You got to be a little bit careful in that area, but if you sponsor events and get marketing and advertising benefits out of it, it's different than a regular just check writing for a charitable contribution. Another con is the entity level tax only allows tax credits for out-of-state tax paid. So for manufacturers or agricultural companies or companies that might have research and development credits for the state of Wisconsin, you don't get benefits from those credits if you do this entity election. So for the most part, it's not going to make sense for manufacturers, not going to make sense for farmers to do this, or companies that have a lot of research and development. It's likely not going to make as much sense for you to do this because you lose out on some of those credits that are applied at an individual level. And another con of the situation is, you are truly making this election for an entity. So if you have a partnership that maybe has 20 different partners, they all have different income from the partnership, different tax brackets. You can't pick and choose who you apply this to. It applies to everybody. So, when does it make sense to make this election? If you're a married filer with over 400,000 of income, or a single filer or head of household with over 200,000 of adjusted gross income, you generally start receiving these benefits. Typically, you start saving around 2 cents on the dollar after income is past these thresholds. There's a lot of factors to consider when making these decisions. So certainly reach out and run some projections to see if this makes sense for you. But I've had clients, I had one, I just looked at a projection this morning and they're saving about $7,000 by doing this election. So it certainly is beneficial for them. And, for a lot of clients that have these PPP loans that as of right now, those expenses aren't going to be deductible and it's going to add your income in 2020. It really is something you want to look into and run some projections on to see if this is worth it and saving you some tax dollars. As far as when you make this election is made on the S Corp or partnership tax return. So this is not an election where you file something before the end of the year. This election's, it's kind of call it a check the box election that you make on your tax return. Does your method of accounting matter? In this case, it does. If you file on a cash basis, you really want to make sure that you make an estimated tax payment in 2020 so you get the deduction. If you wait to make the decision and file it with your tax return and make a payment in 2021, you're not going to get the benefit of that deduction in 2020. If you're on an accrual basis, you don't need to make the payment to get the deduction in 2020, but it really is recommended to make estimated tax payments on these just like you would individually to get not necessarily the deduction for accrual basis, but to avoid any underpayment penalties, because this entity election is subject to underpayment penalties, just like you would not make estimated tax payments on your federal or state returns. The same rules apply here. So, are there ways to project these benefits? Certainly, we can run tax projections to see what your benefits would be for making an entity level election. I think it's certainly worthwhile. Business clients, if you're having a good year, expect a little bit higher income. Because once we run the projections, if your other sources of income are kind of flat in future years, but your business income is really what fluctuates, it kind of gives you a nice baseline and when it might make sense for your business to make this election. So The Biden tax plan. I guess I want to kind of start off with a little disclaimer here that this was the plan with the election. Typically, there's changes and modifications before anything gets passed into law. But here's some of the things that were part of the plan here. So one of them is to impose a 12.4% Social Security tax for wages above $400,000. So if you're a high wage earner above that level, you would have a Social Security tax on your wages. And this essentially would be used to try to make sure that our Social Security, kind of pot of money and Social Security budget just has more money going into it. The individual top tax rate would increase from 37 to 39.6%. And 39.6% is what the top rate was prior to 2018. So it would just be changing those rates back to what they were prior to 2018. The next one is a corporate tax rate increase to 28%. The corporate tax rate right now is 21%. So it would be an increase up to 28. This also applies, a little bit for some companies if you have operating losses from your C Corp. Looking at whether or not you want to carry them back, you might decide to carry them forward with an expected increase in the tax rates. So again, this is just proposed items. Another one here that's going to apply is a corporate minimum tax on book income. This is for really large corporations. Large corporations can have certain tax incentives or use depreciation or other things to really reduce their taxable income. So this is just looking at having corporations making high profits on their books pay some sort of tax. There'd be a temporary increase of the child tax credit and dependent tax credits. So this benefits individuals that have dependents or dependents that are in daycare. And then this last one here reduces the state tax exemptions to 2009 levels. So this one is pretty significant for business owners. Certainly if you've got a fair amount of assets or if you've got a fair amount of real estate in your portfolio. And what right now the estate tax exemption is right around 11.5 million. So for a married couple, you each have 11.5 million. You've got 23 million combined. This would bring this down to 3.5 million per individual or 7 million combined. So there certainly would be a lot of people that might fall into estate tax and may need some more estate tax planning if this actually gets passed into law. So again, these are all proposals, but some things that might be on the horizon. So this last slide here, I just want to briefly touch on some year-end tax planning and cash flow planning ideas for businesses. Tax planning 101, you want to defer income and accelerate expenses. Update equipment or vehicles if necessary. If you're adding more equipment to your business, you want it to produce a profit for you in the future. You never want to buy something just to get a tax deduction. The entity level tax to Wisconsin, another planning method, is spend some time talking about. Retirement plan contributions. A lot of companies have 401k plans. As an owner, there's typically profit sharing components to those plans where you can add more money into your 401k. Methods of accounting is always applicable. You can change your method of accounting if it's not the most favorable for you. This is something you've got to look at in pretty, in the big picture. You don't want to change the method of accounting just for 1 year. You want to look and see whatever is most viable and makes the most sense for your business. And then always, depending on how seasonal your business is, cash flow planning a lot of times comes along with tax planning. If your company files on a cash basis, you need to have cash to reduce your income. And even if your company files on an accrual basis, there are ways to accelerate expenses, and there's ways to get deductions for things before the end of the year. So that is everything that I have. I've seen a few things come here in the chat for Q&A. So I think we'll kind of start addressing those little by little here.
Awesome, thank you all. I do want to just add very quickly. So yes, we are going to be sticking around for a few minutes. We know that we're at our allotted time. So if you have to hop off, that's absolutely fine. We'll be sending everybody the recording and the presentation slides from today. So thank you for joining us if you have to hop off. Otherwise, presenters, feel free to start addressing some of the questions we had come in through the chat. I can kick us off so you have a chance to look over it, but the last one that just came in, probably to Dan, is should we be making a possibly large estimated federal tax payment now based on the non-deductibility of expenses associated with our PPP loan?
Yeah, that's a good question. And right now, I would want to probably talk with your advisor. There's a couple of things to consider when making estimated tax payments. Depending on your income thresholds, there's what are called safe harbors. So if you pay in 110% of your tax from a prior year, you're not subject to any underpayment penalties for anything. So if you were given estimated tax payments to pay, a lot of time it makes sense to make those estimated tax payments, but to maybe wait until April 15th when the tax is actually due before writing a large check. Because, we talked about this a little bit throughout the presentations, but Congress certainly could decide to make those expenses deductible, that the PPP funds were used. And we're kind of expecting on our end that Congress is going to do something before the end of the year, whether it's renewing the payroll tax credits that Jamie had talked about. Those all expire as of December 31st, 2020, or the PPP loan expenses being deductible. We're kind of anticipating a lot of these are going to be part of a larger package. So I guess to answer your question, the long-winded answer is I probably wouldn't make a huge payment unless if you need to make a payment just to cover your taxes from 2019, so you're not subject to any penalties.
Awesome. Another one that came in is where might we keep an eye out for an announcement about the change in the PPP non-deductible expense rule?
If that changes, it's going to be all over the place. So I'm sure we'll have information on it.
Yeah, I think you can probably watch, the news, or you can, we'll get something out as soon as we hear something too on our Wagner emails too. But, like Dan said, it's going to be all over the place on the news and stuff. So everybody's kind of watching for that right now. So.
Perfect. There were some specific questions that we'll follow up with afterwards. John or Jamie, did you see any other questions in the chat that you wanted to just address for everybody to hear before we leave today?
I don't recall seeing anything, John, unless you see something that we maybe missed chatting.
I'm not sure if there's any that we missed. If we did, then feel free just to reach out to us. Jamie, there was a question in the Q&A. Did you see that? A question for Jamie, a staff person used. I don't know if that's too specific of a question or.
I think I did respond about using it over multiple instances for the sick leave. Is that the one you're referring to?
Another one that came in that said a staff person used FFCR hours for childcare because of school closures back in April through June. Can they use the remainder of their time for October through December since schools are still closed? Or did they have to be used in a 12 continuous weeks?
That was in the Q&A, not in the chat section, Jamie.
Oh, sorry, I missed that.
Yeah, if they didn't use the full 12 weeks, it can be broken out.
Right. Yep.
6 weeks before, 6 weeks later, that's fine.
Yeah. Similar to the other question that we had received. Yep.
Awesome. And then one more that just popped in. Do you see that people are starting to receive actual forgiveness on PPP? Is there a 45-day rule that banks are supposed to get back to you?
So I guess I could take this. I've got a lot of clients that have received their confirmation of forgiveness. When you send your forgiveness application to the bank, they have 60 days to look at it. Most banks are turning it around anywhere from 24 hours to a couple days because they want to get these low interest loans off their books. And then once the bank has it, the SBA has 90 days to confirm the forgiveness. So I've had clients that have sent applications in August and September. They've received their confirmed forgiveness. I have other clients that sent and are still waiting. But my expectation would be it's going to be close to 3 months between the time that you submit the application and you hear back. The bank's going to do it quickly. The SBA is going to take a little bit.
Awesome.
I guess maybe just to add to that, I have not had any clients yet who've had to repay anything. They've all got full forgiveness.
Okay. Is Wagner still recommending waiting on applying for forgiveness until 2021 to preserve the safe harbor?
I'm not sure which safe harbor they're referring to.
If you,
No, we can get
submit
back
that,
to that person on that. We
yep,
can,
we can get back to you if you just want to send us an email. Dan, if you want to go to the next slide, which everybody will be receiving, all of the email addresses for our presenters today are right there. Feel free to reach out with that question. Other than that, thank you all so much for attending. One more time, just keep an eye out for another email from us with all this information. We are so appreciative of all your comments and questions, and we hope this was helpful for you today. So thank you, Jamie and John and Dan, for all of your great content. I hope you all have a great rest of your day.
have a great day, everyone.
All right, thank you.
Thanks for
Thanks.
coming.